They always told us water was life. Now, Wall Street says it's an asset. For the first time in history, you can trade the price of water just like oil, gold, or wheat. The very algorithms once busy speculating on mortgages and energy are now tracking the world's great rivers. And behind those screens, a silent, profound revolution is underway, one that forces us to confront a question older than civilization itself. Should anyone be allowed to profit from human thirst? Welcome to the chronology of wealth where money, power, and history collide. And nothing is ever as simple as it looks. What is unfolding in modern trading rooms is not new. Every empire that attempted to master nature, from the stone grandeur of Rome's aqueducts to California's sprawling pipelines, learned the same harsh truth: he who controls water controls life. In the beginning, water held no price tag. It was worshipped. The Sumerians carved complex canal systems into the Mesopotamian mud, effectively giving birth to the first city-states through masterful irrigation. Egypt's destiny was tied to the predictable pulse of the Nile. Its control meant absolute power. When the floods failed, so did the pharaohs. The Code of Hammurabi, one of the earliest legal documents known, imposed severe penalties for stealing irrigation flow. To deny water was to declare war. For the ancient Romans, water became sophisticated infrastructure, a highly organized, monetized system. The aqueducts spanned hundreds of kilometers, feeding fountains, public baths, and elite palaces. Yet, even in this empire of engineered abundance, deep inequality was rampant. The wealthy diverted massive flow to private estates, leaving the poor to queue for a trickle at public fountains. Rome's utilities were public in name, but their management belonged entirely to the elite. When the empire finally collapsed, the aqueducts followed stark. Stone reminders that no empire can outlast its primary source of sustenance. For centuries, control of water remained the ultimate determinant of survival and dominion. From monastic mills in medieval Europe harnessing economic power, to ingenious Qanot systems in the Islamic world turning deserts into blooming cities, the rule was absolute. Master the water, master civilization. Then came the Industrial Revolution, marking the definitive moment of water's commodification. It ceased being divine and became merely useful. Rivers transformed into the literal veins of industry. Control the river, control the economy. By the 19th century, with cities exploding, water became a political and hygienic battleground. To fight disease, governments and private corporations built massive utility networks. This was the moment a public necessity quietly morphed into one of history's most profitable systems. The pattern was set: public need, private profit. In cities like Paris and London, private conglomerates, the ancestors of today's giants like Veolia and Suez, quickly dominated distribution. Water had crossed a definitive line. It was no longer a shared gift. It was a service, and services must have profit margins. In the 20th century, this foundation became geopolitical. Dams birthed immense power. Pipelines carved farmland out of deserts. The American West became the proving ground for this logic. Los Angeles, for instance, was built not where water existed, but where it could be brutally imported. The infamous Owens Valley Water Grabber project of legal theft engineered by William Mulholland drained an entire farming region simply to fill LA's urban reservoirs. Progress disguised as necessary theft. The geopolitics of water hardened quickly. The Nile, Jordan, and Tigris-Euphrates systems became geopolitical flashpoints. But a more dangerous shift was occurring in finance. In the 90 Sekunde, the World Bank and IMF aggressively pushed dozens of nations to privatize their water utilities under the banner of reform. The neoliberal mantra was clear: markets are efficient, governments are not. The result was often catastrophic. The most infamous example remains Cochabamba, Bolivia, in 1999. When water rights were sold to a US-led consortium, prices instantly tripled. Bills became impossible burdens for the poor. Even collecting rainwater was declared illegal under the new concession. The people revolted. The contract was cancelled. But the chilling message was delivered. Water had officially entered the global market. After that, it was inevitable that finance would follow. The rule of capital is simple. Anything that can be measured can be traded. And as the planet began to run critically dry, the potential profits became undeniable. California, with its relentless drought cycles and massive agriculture, became the perfect laboratory. Farmers were already trading water rights, treating legal claims to a resource much like land. If you own it, you can lease it. But Wall Street demanded scale. In December 2020, the CME Group, the world's largest derivatives exchange, launched the first ever water futures contract pegged to the Nasdaq Vel's California Water Index. Suddenly, investors could either hedge against or, critically, speculate on the future price of water itself. Water was no longer solely a human right. It was an asset class. Who is playing this game? Not the local farmers. The players are institutional, hedge funds, asset managers, and speculative investors looking for exposure to what they politely call natural resource volatility. In simpler terms, they are betting on drought. When water gets scarce, prices soar. When prices soar, investors win. This is how finance seamlessly translates morality into math. Drought becomes opportunity. Thirst becomes yield. And scarcity becomes the most reliable asset of all. We've been here before. Every financial instrument starts as insurance and inevitably evolves into rampant speculation. Mortgage derivatives were supposed to spread risk. They triggered the 2008 global collapse. Carbon credits were meant to reduce pollution. They became a loophole for polluters. Water will follow the same predictable path. This is why water futures are so significant. They mark the moment the financial system begins treating survival itself as a tradable commodity. BlackRock calls water the new gold. Goldman Sachs refers to it as the petroleum of the 21st century, and as climate change accelerates global instability, these markets will multiply. Economically, the move is rational. Ethically, it is chaos. Because once access to water depends on your credit, you are no longer a citizen, you are merely a customer. The defenders of water futures insist they are not trading physical water, only the right to hedge price volatility. That is a semantic shield. Because when profit depends on shortage, there is very little incentive to create abundance. This is how capitalism traps itself by confusing management with monetization. The financialization of water isn't a new invention. It's the next stage of the same ancient story. The difference is that the control isn't physical anymore. It's abstract. It's not armies guarding rivers. It's contracts controlling rights. It's not empires drawing borders. It's investors drawing graphs. The core question history keeps asking is this: who decides the price of survival? Because once something has a price, it can be denied. Wall Street's new bet is not on the water. It's on us, on our willingness to accept that even the most essential element of life should belong to those who can afford it. But water does not obey markets. It floods. It evaporates. IT escapes. And sooner or sooner, it reminds every empire that ownership is an illusion. The final rule of finance is the same as the first law of nature. You can't drink a futures contract. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.